One of the most commonly used technical indicators is a simple moving average. In this video, we're going to cover what a simple moving average is, how it's calculated, and the strengths and weaknesses of moving average indicators. If you turn on almost any financial network or listen to any technical analysis, you're likely to hear a discussion about where a stock is relative to its moving average. So what is a moving average and why do so many people use it? A moving average is a visual way of smoothing out the trend of a stock. Well, sometimes being able to recognize which way a stock is trending is not as easy as one might think, and so a moving average can help to make it easier. A simple moving average is calculated by taking the mean of a select number of trading periods, plotting a dot on the chart at that point, and repeating the process for the next trading period. For example, a 10-day moving average would average the last 10 days' closing price of the stock. The next day, it would repeat the process again. In our example here, you can see that the average price of the stock over the last 10 days was $9. If we move forward in time, the average would change as the stock price changes. Moving averages are designed to smooth out the overall price trend of a stock. A shorter moving average will follow the stock more closely, and a longer period moving average will be less reactive to short-term stock movements. Moving averages can be used many ways. The simplest way to use a moving average is just to say, which way is it pointing right now? For example, on this chart, you can see that the 200 period moving average is angled up at the moment. That means that for the last 200 days on average, the stock has been moving up. Some commonly used moving averages are the 20 period moving average, the 50 period moving average, and the 200 period simple moving average. The 20 period moving average on a daily chart represents approximately a 1-month trend because there are about 20 trading days in an average month. The 50 period moving average is considered to be a nice mid-term trend moving average, and the 200 period moving average is designed to smooth out the longer term trend. Many traders like to have multiple moving averages on the same chart at the same time. This helps them see where short, intermediate, and long-term trends are relative to each other. All technical indicators have strengths and weaknesses. Well, since a moving average is designed to smooth out the trend, it makes sense that it's a more effective tool in a market that is trending. In sideways markets, moving averages are less effective, and they can even give you false entry and exit signals. It's also important to recognize that, by definition, moving averages are a lagging indicator. They average past price movement. No technical indicator can tell the future, but studying past patterns can help an investor make future decisions. Since moving averages can be used many ways, it's important to be consistent with how you choose to use them. Study, experiment, and see if moving averages are a tool that can help you better structure your investing decisions.